Guest on the show now. We do have Ajay Srivastava of Dimensions Corporate Finance Services joining us right now to take some questions. Mr. Srivastava, thanks a lot for joining us. This is Pavitra. Your first thoughts on what came out of the RBI policy? I mean, of course, they've hiked by 25 basis points, but like Surbhi was pointing out, there still, seems to be caution in the tone of the Reserve Bank. So your thoughts?
Good morning. I think caution is all in the words. The reality is a 7.8% headline Q1 growth rate by RBI tells us the story. The story is RBI is going for growth. Inflation is not going below 5 next year. They don't care about it. So for the corporate, if you're a corporate today, it's good news for you because this RBI is now clearly focused on getting you to growth. It did not say I'll bring the growth down to get inflation below 4% the target. It said let the growth be 7.8. Now that's beyond anyone's imagination. So if an RBI is targeting 7.8, notwithstanding that inflation is not going to go below 5%, it's very, very good news for the corporates. That means the pivots are going to be open, the government will fund the growth, and therefore take that very clear maxim. The reality is growth at 7.8, inflation above 5, the fight of inflation is gone. We are back in the growth business. Very good news for equity market. Maybe bad news for banks because they need to find funding for the deposits, but that's good news for you as a depositor. So you have a good, if you're a depositor, you got the best of times coming. If you're a consumer, brace yourself. RBI is not going to protect you from inflation. If you're a corporate, 7.8% growth, go for it, guys. Best news possible.
Ajay, while the RBI is gunning for growth, most of the economists we spoke to seem to indicate that the RBI's projections for growth are optimistic. So 7.8 is what they've projected for Q1 of FY24, but for the full year, they're at 6.4%. Upasana Bharadwaj of HSBC was saying that we're below consensus at 5.6%. So, it's clearly a divided house when it comes to what the actual growth rate is going to be. Would you say the growth rate is overly optimistic and therefore we shouldn't jump on the growth bandwagon?
You may be right that the growth could be overly optimistic, but I am certainly not in the economist pessimist bandwagon of 5%. At the end of the day, the capex spend of 10 lakh crore is going to come out somewhere in the system. It's not consumer spending, it's capex spending. So, if you run by my company or my business by economists, maybe I'll be dead by now. Okay, so believe them, but not too much of it. I would say 7.8 is an overreach by the RBI governor, but we are certainly on the trajectory of higher growth. I think the important point is that the central bank is plumbing for growth along with the government in an election year. And I think that's the takeaway from this credit policy. We can argue, is it going to be 7.8, 7.2, 7.6? We can argue 0.2% here or there. The fact is, trajectory is growth is on top of the agenda in the election year, both for central bank and for the government. So leave aside the economists. I think they do their work, whatever they do. But I think if you're a corporate, you'll be planning for growth and not getting pessimistic about 5.5% growth rates and so on.
That's the takeaway, right? Pre-election year, election year, and the RBI and the government, they want growth.
And perhaps so does the rest of the country. So I get Ajay's point on not being a pessimist. Ajay, good morning. Surbhi here. Great talking to you.
Good morning, Surbhi.
And you're rarely in the pessimist camp, right? All these years that I've been speaking to you, unless there's something really big out there, a black swan, you're rarely in the pessimist camp, which is a good thing. So what are you buying? Because there's been a sale underway in the markets. So tell us, since you are optimistic and you're looking at growth, so what are you buying?
Surbhi, you've been missing me of late. I can tell you that. Since the last 8 months, I've been telling all your channels, spend your money, don't invest the money. And I'm very clear in that, still in the firm path, that spending your money is the best way to use your money. So in an economy we are in the pricing we are in Indian equity market, you cannot make money on stocks. It's very, very difficult. It's going to be a tough climb for any fund manager to make money compared to fixed income. So if you really want to make money, spend it or put in fixed income. You want to gamble with equities? Go ahead, be my guest. But I don't think equity returns in the next 12 months are going to be anywhere close to fixed income returns with the volatility that comes with it. So yes, I'm optimistic, but I still believe that spending your money or putting in fixed income is a better idea today than putting in equities at these valuations. Pick up any good company, Surbhi, in India. Any good company did a very good result. Let's take Naveen Fluorine, which gave a beautiful result. P's of 80 and above. Now, how do you justify buying those companies? So leave aside the fiasco of Adani Group, etc. Any other company which is good is expensive. Maybe barring an ITC is something which you may think is cheap. But in the whole economy of India, in the whole market, you don't find cheap stocks. So spend it or invest in fixed income.
But Ajay, that's been the reality for Indian stocks since Kingdom Come, right? Time immemorial. We've never been a cheap market. Anyway, I won't push you on, giving an equity outlook. But if you're looking at fixed income, then what's your expectation from that market?
See, fixed income market is a very good market today because the options have become multifold, and you are for the first time vis-a-vis the banks you're in a commanding position. The debentures in the market are 12% and above. Even double-rated debentures are 12%. Now, to get a 12% return in the next 2 years on equity is a very difficult task at the end of the day. So I would still say that plumbing for 2 to 3 year, 4-year debentures is a good strategy to have at this point of time. There's not much liquidity in large size debentures, but that's the liquidity. The REITs are good at this point of time. Fixed deposit, if you like bank fixed deposit, they're good. But I think the bottom line is equity investment has to be done sparingly in clean companies, in clear companies. And I still believe that equity investment, if you really want to do it, should be focused on where the government is spending the money, which is infrastructure services companies. Those are the ones which are going to gain because they will get the order, they will execute. So whether it is your execution companies and whether it is your company like Siemens, etc., who bring in the locomotives in the country, whether it's a CG Power, those are kind of companies we have invested in. Those are kind of companies which is going to gain from it. The fact is India's consumer story is struggling at this point of time. So you're really focused, you're very, very narrow segment of equity market. Now, can it take the market up? That's where my doubt is. Because if you put out all the capex related companies, they're not more than 10 in this country. Now, can 10 companies create a summer for Indian investors? I doubt it. But if you're a hardcore investor, maybe that's the place you focus your life and rest put it in fixed income. Wait for another day. No hurry, as market tells you. You always get a chance to get in.
All right, Ajay, thanks a lot for joining us and taking
You're
us
welcome. Have a good day.
You too. Have a good day. Thanks for taking